All right, all right. Let's go ahead and get started. James, what's going on? We got some familiar faces in today. Good to see you joining us. Kenneth, thank you. Irish, rock solid, my personal rock star. Help. Thank you, Irish, for being on. James, Sanjay. Let's see, Jonathan Roberts. We still got some people joining in. And let's also check to make sure we are live on Facebook. So yes, we are live there. So we should be good to rock and roll. Can you all hear me? Am I coming through fine? Like if anybody can give me something in the chat or a thumbs up, let me know if I'm all right. Yes, Sanjay says gave me a yes. All right, so we are good. I got the thumbs up coming in. Good. All right, so let's rock and roll. We got a lot of stuff to cover today. Even got my man Brandon hopping in. What's going on, my man? Um, cool. So I want to go ahead and just dive right into this because there's a lot I want to cover. And so we'll get into that really quickly here. For those that don't know me, my name is Jason Stubblefield, and if this is your first time joining in, this is not my office. I'm actually in Washington D.C. right now, traveling for a conference. So we got to make it work from a hotel room. We'll just make it work from a hotel room. So bear with me. I'm not going to have my multiple monitors, screens. It's probably going to be a little bit slow, but the content the content would definitely be useful for you. So those that don't know me, name is Jason Stubblefield. I've been investing in multifamily apartments since 2015. I will go ahead and do a screen share right now. This is going to be weird, but we'll do it anyway. I also used to having multiple monitors. So if you can, you should be seeing my screen right now. It's all over the place, but snscapitalpartners.com. That's like Sam, Nancy, Sam, capitalpartners.com. This is my website. If you don't know anything about me, you can log on right here to see a little bit about our company, what we're all about, some of the projects that we've done, testimonials from some of our investors. If being a passive investor is something that is appealing to you, if you come right over to the invest tab, probably I should close that because I think y'all are seeing that. But anyways, if you go to this invest tab, there's a button here. You can join our community. What will happen from there is you'll get an email. We'll set up a time to talk to see what your investment criteria are. That will also put you into our database so you can hear about our future opportunities. And we do have some future opportunities that are coming up in the very near future. So if you want to get on that list, go ahead and do it now. We'll have a conversation, talk about your strategy, see if your strategy fits with what we have to offer, and sort of go from there. But anyhow, let's go ahead and dig into it today. So underwriting multifamily apartments, evaluating apartment complexes is something that you all need to know. And before I get into this, I just want to go ahead and set the stage. Last week, I did a talk about our current environment. We talked about the economy. We talked about rising interest rates, what the Federal Reserve is doing. And really at the end of that call, what I teed up is what I strongly feel that we are about to embark on probably the best buying opportunity that we've had in well over a decade. Where we are right now with inflation is a place that we have not been in the last 40 years. Sanjay, do we have the report of that webinar? Yes, we do. So we get it to them. I think Irish may be able to help. If you can't, just after this is recorded, you'll get the replay of this, but just reach out, reply to the email. We'll make sure you get that. But we haven't been in this place in the economy in the last 40 years. So it's very, very unique. And what's going to happen, what I feel strongly is going to happen, is we're going to continue to see the rise in interest rates. We're going to continue to see market changes and shifts. But if you're savvy, if you understand, I can't really tap on the table like that. I'm on, I'm a wiggle the screen. But if you are if you are savvy as an investor, if you understand how to evaluate apartment deals right now, then what will happen for you is that you'll be buying through these years. And when the market turns around, because history has proven this over and over again, every time we have a collapse in the market, it always bounces back. If you take advantage and you start buying up those opportunities right now, then in the future, you'll be set up and millionaires are made every time there's recession, every time there's depression, every time there is a collapse. And so you taking time out of your Tuesday to join in to a talk like this is hopefully going to be beneficial to you. And what I want to do right now is to provide you with useful content that you can use in order to take advantage of the market situation right now. Also, with this, when it comes to evaluating apartment complexes, I don't want this just to be a lecture where I come through and just give you all information. You've taken your time out to join right now. So if you're on Zoom, put your questions about evaluating apartments into the chat right now. If you're on Facebook Live and you have questions, specific questions about evaluating apartment complexes, we're going to be here. We're going to hang out, hopefully 30, 45 minutes, but I want to get through as many of those questions as possible. So I'll take maybe another 5 minutes to sort of tee everything up, and then we'll go ahead and just dig right into that. So we have a vast array of people who join. Some people are very savvy, have been buying apartment complexes for years. Some people are fairly new, right? They haven't bought a deal at all. So I try to cover everything. If you are pretty savvy, bear with me, but we'll get into some of the more intricate details in a little bit. So starting off, the key thing that you need to know between multifamily and single family investing is that multifamily apartments are evaluated based on income. Okay. So we really don't care about where it's located at. One of the things that was very pleasing to me coming from residential into commercial real estate is the fact that you don't have to be concerned about, oh, is it overlooking a lake, or what the walls are painted and the paint scheme, how does it feel when you walk into it? As a buyer of apartment complexes, none of that really matters. I mean, it does matter to a certain extent, but you're not buying properties based off how you feel about them or the paint. You're really buying properties based off of the income that they generate. And so there's a lot of benefits to buying apartments, economies of scale, being able to have multiple doors in one transaction, multiple doors under one roof, all those things. And you can go through those. You probably heard that throughout the internet. There's a lot of that going on, but the biggest thing is being able to buy based off of the income. So knowing that now that we have a decline in market or rising interest rates, if you're still buying off of income and you're buying for cash flow, that just means that the price that you pay is going to have to come down in order to make sense out of your numbers. Knowing that, that's why this is the best buying opportunity. I feel like that we've seen in well over a decade, and maybe further into the future. I can't tell the future, but really feel like we're sort of set up. So with that being the premise, knowing that we're buying based off of income, must understand that we need a method of evaluating how much that income is worth to a potential buyer. Okay, so if you are going to buy a commercial property, commercial real estate, then we are going to need to measure that, and we measure that by the cap rate or capitalization rate. Okay, this is this key metric for you to know when buying apartments. So if you are buying off a cap rate, Jason, what is that? So let's go ahead and talk about it. Let's see if I can share a screen and bring up a whiteboard here. So bear with me for my handwriting, but we will get into it. All right. So cap rates are determined. We have the income that a property generates. Let's see if I can get all this going. So we've got get up here. So we've got income. All right. I got to stop pushing this button. There we go. And let's say our income is 200,000. That is 200,000. All right. And we've got expenses in the property. Very simple here, right? Y'all can follow me along. Not going to lose anybody on this. And those expenses, let's say those expenses are $100,000 in our apartment complex. We get to this number when we subtract that, and we get a handy dandy $100,000. Okay. So if we're talking about $100,000, this $100,000 is what we call net operating income, or NOI for short, right? So this is your net operating income. This is the metric that you really care about. Now that we know that we have $100,000 in income, how much should I pay for this $100,000? And that is where we get to the capitalization rate, or the cap rate. So if I have this $100,000 and I say, well, that $100,000 is going to be worth, let's call it a 10 cap, right? You probably won't see this, but we'll say 10%. I'm going to give you 10%, and this is getting all screwy now, but 0.10 or 10%, right? Multiple ideas going on at the same time. But if I divide that $100,000 by 0.10, I will get $1 million. Okay. So that means if I want to buy $100,000 at a 10 cap, I will pay $1 million. Now, you could also say that I will take the same $100,000, nothing changes, right? $100,000 in net operating income, and I may divide that by a 5 cap, 5% or 0.05. Now, if I did that, that math will check out to $2 million. Okay. So you may be asking yourself right now, well, where do these changes in numbers come from? Where's the 0.10 and where's the 0.05 coming from? This is going to be dependent on your market. All right. Depending on what market you are in is going to determine whether you are using this number right here, and that's a bad arrow, or if you're using the 0.05 or 5% cap rate. Okay, so knowing what type of market you're in is going to have a big impact on your capitalization rate and how much money you'll pay. And so let me just sort of explain what happens, or why that is. If you had an apartment community and you put it in, say, a place like Bucksnort, Tennessee, that's a real place. It's a real place. I love the name Bucksnort, so I use it as my example. But if you were going to buy an apartment in Bucksnort, Tennessee, and it made $100,000, well, Bucksnort, Tennessee isn't that attractive. And so because it's not that attractive, you may only say, I want to pay $1 million because it's in Bucksnort, Tennessee. If I took the same apartment community, right, same apartment complex, and I put it in, let's say, Manhattan, New York, right? Well, because it's in a better location with a lot more people around, it's more attractive to investors who want to own there. So they will pay more money or a lower cap rate for the same $100,000 of income. And that is where you get to your cap rates. So as a multifamily apartment investor, what you must know is the capitalization rate of the market where you're buying. All right, because once you know the cap rate of the market where you're buying, now you can determine how much you should offer on properties. All right, so that is foundation of sharing right there. I mean, foundation of buying apartments right now. So let's see. And I want your questions. I want to make sure that I am answering questions as we go along. I'm looking at Zoom. I don't think I lost anybody right now. We got the DMV in the area. Let me check over on Facebook Live. Is anybody lost right now? We're gonna pause briefly to just see if everybody's with me. Let's go. Let's go. Where is my Facebook Live at? Bop, 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 bop. Let's see. Okay, good on Facebook. All right, so everybody's following along with me. Cool. So let's keep moving then. So as knowing this, okay, we did get one. How do you figure out cap rates if you don't have MLS access or a host? Yes. Yes and no, James. For one, the multifamily world is not a MLS type of MLS, or where real estate agents are hanging out, is not the ideal location of where to get cap rates from. It's not the ideal location of where you're going to find multifamily apartments at. MLS is like for residential brokers, and every now and then they come across apartment complexes and they are listed. You should check that, but it's not going to give you a consistent amount of deal flow. Why? That is because commercial real estate um, tends to trade with commercial brokers, and commercial brokers aren't on the MLS because that is a residential database. So you can check on MLS, but you need to get off of that. If you want to determine what a cap rate is, here are a couple of ways you can do it. You could find a broker, right, and talk to that broker. That broker will allow you to um, they'll give you the information, right? Here's what cap rates are, here's where cap rates have traded, right? You can look at that. You can also yourself try to pull historical data. Now, this is a little bit more complicated, but if you have a broker show you a property package, and then you can reverse engineer what the cap rate was if it's already closed. For example, if you see a property and you know that it closed for $2 million and it had $100,000 in net operating income, then you know that that property sold for um, it sold for $2 million. Okay. So you can reverse engineer if you know the sales price and you know the net operating income. It's simple math for you to be able to figure out what the cap rate is. Also, if you know the cap rate and the NOI, you can figure out what the sales price is. Okay. So that's some very basic information. Also, CoStar access. And CoStar is sort of like the really the best resource when it comes to data about commercial real estate that I found. CoStar, though, is relatively expensive, but most of your brokers have it. Also, there are underwriters out there and investment bankers. So you just have to ask, do you have CoStar access? And then they can pull you a CoStar report for your market that can tell you the cap rate data. All right. So does that answer your question, James? Hopefully so. But you need to find that out, and there's multiple ways that you can do it. Once you know that cap rate, then you can start utilizing that to evaluate your deals. Now, here is how we evaluate deals. We start off with our cap rate, but I am a value add investor and you should be a value add investor. So you take the current value that you're buying it at, the current net operating income, and then you project into the future what you feel like the net operating income will be. So how do you do that? Well, you say if rents right now are $1,000, and let's just say they're going to go up by 5% a year over the next 2 or 3 years, then you would project that out and say, all right, well, rent's going to go up. Let's just call it $1,200 into the future, right? The math on that may not check out, but just follow me, right? So we have initial rents at 1,000. We say future rents will be $1,200, and then based off of that, if we understand our expenses, now we can get a different NOI. Okay, so we take a different NOI. Now we have a delta. So let's go back to the whiteboard just to make that clear. And I probably can use the same one here. So, Bob. All right, we got something new. So let's say we'll just go with this real quick. So we've got our NOI of $100,000. All right. and we say we bought that at a 0.05 cap, right? So now we're at a $2 million evaluation for this property, okay? And that's where we are today. Now, let's say, because I can raise rent, so I can reduce expenses, I can play with this NOI number here. And let me title that for anybody who's tracking, right? This is my NOI. You gotta just bear with me with this handwriting. But if I take that 100,000, and let's just say I can make it $150,000. Okay. And I'm doing that because I'm increasing the rents, and that's over a year. So you may think $50,000 is hard to do, but it's actually not when it comes to apartment complex. Depending on how many units you have, if you're doing, call it $50 increases, and you have 100 units, right? So that's $5,000, $5,000 a month, right? If you take that and you extrapolate that over 12 months, then that's an additional $60,000. You follow me? Just from a $50 increase. So some of you may look like, how am I going to get $50,000? In apartment complexes, it's really not that hard. But let's just say in this example, we go from $100,000 in NOI to $150,000 in NOI. We're going to keep the cap rate the exact same, and we're going to do this division. Now, I'm not going to attempt to do that in my head. If anybody else can do it and put it in the chat, go ahead and do it. But what is that? What's that number? We have 150,000 and divided by 0.05, then we have 3 million, right? So went crazy over there. So that makes our new evaluation $3 million. And so we can make $1 million in profit with the same cap rate just by making $50,000 in extra NOI over the course of a year. $50,000 in the course of a year, depending on the size of your property, could only be a $50 increase in rent, right? So it's everyone tracking me there, right? And I'll go ahead and stop sharing that. So doing that is how you capitalize using the cap rate off of just knowing information and projecting that information into the future. All right. Again, if you have questions, go ahead and put it in the chat. I'm about to wrap this up. I've been going for about 20 minutes here, but I really want to make sure that this is serving to you all in the terms of getting your underwriting questions answered. All right. So not just me simply telling you what to do, but if you are doing it, I want to make sure that you understand how it's done and get your questions concerning it answered while we're here. Okay, if nothing else, I'll keep moving on. Now we're about to get into something juicy, and this is for all the people who have been in the apartment space for a while. So when you are when you're evaluating, when you're determining how to go from that $2 million evaluation to a $3 million evaluation, you're going to use a model. You're going to use an investment model. And there's several of them out there, but I'll show you the one that I created and what we use on our deals. Now, if you're new to this, don't freak out, right? You just say like, what are all these numbers? What's all these spreadsheets? What's all these tabs? I'm just giving you a brief example of what an underwriting model will look like. If you are into buying apartments, you definitely need this. So either some of you have seen models like this already, and some of you may be completely shocked right now, like, oh, I don't like all these numbers. But let me briefly just explain how this works. This is very simple, right? It's a lot of different numbers, but these numbers, once you underwrite a few deals, you're not changing that much, right? You're just gonna start and inputting information. In my model, you only change everything in red. Everything in black will stay the same. And even though I have all these tabs right here, The only one that really matters, the only one that really matters is this dashboard tab that you're looking at now. And so based off of this model, you're going to be able to determine how much money the project is going to make, how much money your investors are going to make, how much money you are going to make. And so don't be too alarmed with this model. Just understand that you get it, you put in some numbers, and the model spits out return information that you use to say, is this a good deal or is this not a good deal? All right, and I'm gonna stop sharing that. I'm not gonna bore you all with just um, going through everything in that model. Right. So did get a question. Yes, how are you finding out market rents? That is an excellent question. So let me back up here. Okay. Cap rates, we got that. Contact a commercial broker. How do you calculate the mortgage debt expenses, assuming everyone is not paying cash? Newbie question, I'm sure. That's why you're here, right? Because we want to answer those questions. So calculating the mortgage debt is something where you need to have a conversation with a mortgage broker or a few mortgage brokers. So I like to have one mortgage broker, one Fannie, one Freddie lender, and then ask them how they would underwrite or what they would lend on a potential project. And that will allow you to figure out what the interest rate is going to be, if they're going to be interest only payments, how much loan to value they would loan you, right? So hopefully that answers your question, Jonathan. How are you finding out market rents? This is another good question. So you find out the market rents in a few different ways. There's the unpaid way, which is you can go to apartments.com. What I've done in the past, go to apartments.com. You look for apartment complexes that are close to the apartment building that you're buying, and then you see what they have on apartments.com as rent. That is a comparable property that you can use. A better way of doing that is to find similar properties and call them, right? So you call the property yourself and say, hey, how much is for a 2-bedroom? How much is a 1-bedroom? I've done this several times. Just pretend like you're a tenant. Hey, I might look at a 2-bedroom. I might want a 3-bedroom. Matter of fact, while I'm at it, let me see what 1-bedroom is, right? And you're just finding out information like that. That's the manual process. Another way I mentioned before, CoStar. This is not free, but you can use CoStar. Someone who has CoStar access, where they can pull that data, which actually feeds in from apartments.com. But they can pull that data for you and be able to give you some useful information about your rents there. Okay. So good. Thanks for, okay. We went through the comps. Can we get access to that spreadsheet? Not at this point. And the reason behind it, there are some online that you can pay for. Mine is sort of proprietary that I use internally, but I'm going to talk about that. I'm going to talk about that in detail. So Kenneth Kuhn says best resources place to identify commercial properties. Yes, you want to go to websites like loopnet.com. That's LOOP. I'll put that in the comments. Loopnet.com and Crexy.com. And those are two places where you can see all the commercial, I said all the commercial, where you can see commercial properties listed for sale. And I'll tell you right now that that may not be the best place for you to find deals, but it's a great place for you to find brokerages. All right. So if you want to know what brokers are selling properties, they will be listed on those websites. And what you want to do is register with all those different brokerages, get on their email list so that when they have properties, they'll come to you. All right. So let's see. Hopefully that answers where to find commercial properties. To Jason's point, we bought a property with only 33 units and the rents were $800 a month. They are now $1,800 a month 3 years later. So yes, if you are on Zoom and you're reading that comment from James, right, or Jim, So Jim is saying that they went from $800 a month to $1,800 a month in 3 years. And so if you're doing that, you can make tons, right? Tons of money off of one property, and that's only 33 units, right? You can do this with a 5 unit, you can do this with a 6 unit, 33 unit, 500 unit property. Doesn't matter. Once you understand commercial real estate, the same process works for all of them. Okay, so yeah, James, we'll talk offline about the spreadsheet, but so just understanding that you need to be able to evaluate it, understanding how you can use cap rates as leverage in order to be able to create millions of dollars. And I'm not even exaggerating. Like Jim just gave an excellent example about how millions are created. And what I'm doing this for is because I want you to be able to take advantage of what's coming. I want you to be able to understand that there are millions to be made if you will just take the time to understand the information and use it to your advantage. Now, to those people who have been underwriting deals for years, for those people who have been in the game and are understanding, you understand cap rates, you understand net operating income, but you are struggling to find deals. Here's what I want to say. I'm going to make a bold statement right now, but I'm going to say it. Most of the underwriting spreadsheets today are no longer useful. I'll repeat that. Most of the underwriting spreadsheets today just are not useful anymore. Jason, why did I show you a spreadsheet that I use and then tell you that it's not useful? Here's why. Years ago, 2015, 2016, you could buy properties at 8 caps, okay? And what that is, if you're not in the market, it's a very attractive price, a very attractive cap rate to be able to buy a property at. So if you can buy a property at an 8 cap, you can put it into a spreadsheet, and that spreadsheet will spit out some numbers. Then you could take the numbers that were spit out by that spreadsheet. I lost my Zoom here. You can take the numbers that were spat out by the spreadsheet, and you could just use that, right? You could just go right from the spreadsheet, make an offer, take that offer to the broker, get it accepted. Yeah, you may have to go through a few hoops and some negotiations or whatever, but if you did that, I don't know what this is. I think somebody's calling me on Facebook. That's not gonna happen. But anyway, we've heard phones ring before that. They'll ring again. But so what I'm saying, right? Why most of the spreadsheets don't work is because years ago cap rates were just higher, and you could use that spreadsheet, go right to a broker, make an offer, and be competitive. What has happened now is that we were buying at 8 caps. Then the market inflated, and then they were buying at 7 caps, and then market inflated some more, and then it went to 6 and to 5, and now there are properties that are being sold at 4% cap rates or thereabouts, right? And even underneath that, depending on what market you're in. So you no longer have the privilege of just putting some information into a spreadsheet that you bought or somebody trained you to use and go out and make offers on that. You're not going to be competitive enough because most of the spreadsheets are not detailed enough to actually give you the information to go out and buy a deal with. I'm not saying that they're useless. I'm not saying that they don't have any benefit to you anymore. What I am saying is that being able to just go from a spreadsheet directly to an offer does not happen. We probably spend, our company right now probably spends a week to maybe a week and a half from once we get the spreadsheet done to actually being able to come up with the offer. And why is because we're doing a lot of things that, to be honest, a lot of people that are training or coaching people on how to buy apartments aren't telling you that you need to know, but aren't telling you that you need to do. But because you're listening to this, now you're going to understand some of what you need to do in order to make this happen, in order to actually be able to go grab a deal right now. And look, I am a person who I've spent well above $40,000 on my education, and I'm grateful that I've been able to do that. I'm grateful for the knowledge that I learned. But I'll tell you, I have taken that amount of money and invested it, and still found out that, hey, I am working with somebody. I paid someone for the mentorship or coaching, and then asked to see their underwriting model, and find out that the underwriting model that they're using isn't the same underwriting model that I was given, right? And there's extra steps, extra pieces in there, right? So one, software rate. If you are not understanding the software rate, what it is, how it affects your investment, you probably don't know enough, right? And I'm not saying that you can't go buy a deal, but that is some of the information that's sort of left out. If you do not have a tax consultant or tax appraisal on your team, somebody you can call to determine your taxes, you do not know enough. If you do not have a loan officer, right, a loan officer who can tell you what today's rates are and the type of loan terms that you're going to get, you do not know enough. And so for that reason, that's why I say you cannot just go from an underwriting model directly to an offer and think that you're going to get a deal done, because you need to take more steps. Those steps are where you're going to confirm those assumptions that you've made. There are groups that are buying deals with 5 years of interest only. Now, if you show up with your spreadsheet trying to compete and win a deal, and somebody, you don't have any interest only, or you only got 1 or 2 years of interest only, and somebody else is coming in and they got 5 years of interest only, well, guess what? They're going to win that deal and you're not. Why? Because they have better debt terms. And if you are not getting your debt quotes updated on every offer that you make, you're just not going to be competitive enough. All right. So James said, what's the software rate? It is the security overnight funds rate. I may be wrong on that acronym. So, but just like the Federal Reserve has a rate where they are willing to loan money, there's the software rate. And so the software rate is a rate that's used to determine bridge debt. So it's going to be like your floor bridge debt, and then lenders will place some spread above that software rate, and that will be the rate that's used for determining your interest rate. And it adjusts if you are doing an adjustable mortgage. So what I'm saying is there's a lot of deals that happen over the past few years that happen as bridge debt that had adjustable rate mortgages, but a lot of spreadsheets don't even talk about what a software rate is, or account for the adjustability of that rate. So you're not locking a rate, or if you're using a model, you may be confined to just using a fixed interest rate. All right. And so I say that because I want you to be able to go out and buy deals. And in order for you to be able to do that, you're just going to have to be a little bit more savvy right now than you may have been in the past. It's no longer time to just look at a spreadsheet and go directly to make an offer. You're going to have to put in some details, put in some effort, and go find out what your taxes are going to be, what your debt's going to be, what your insurance quote is going to be. Know what those numbers are, because it's not price where you can just show up and buy a deal and make a lot of money. Right now, it's very competitive in the multifamily space. And so if you could take those extra measures, it's going to give you the tools that you need to be competitive. I know investors who always talk about, I won't say always, but have repeated to me, hey, I can't get close on a deal. I don't know why they're buying that deal at that price. It doesn't make sense. There is some money out there that's just very different, but there's also people that are in the same space that you are that are buying deals. And so I like studying like basically just laws of the universe. One of the laws of the universe is cause and effect. For every cause, there is an effect, right? So if you say I want my effect to be I buy apartments, then your causes, what will caused you to buy an apartment? Well, I educated myself. I'm making a lot of offers. I understand the market, right? Those things will be the causes that will lead to you buying deals. But here's the part that's a little frustrating to me is you also have to know cause goes to effect, but effect also has a cause. And so what are you getting at, Jason? I'm talking to people and their effect is they've known multifamily for years, but they've never bought a deal. That's their effect, right? The cause of that is because they never fine-tuned the underwriting model to figure out why there's such a gap in between where they're offering at and what the actual sales price is. Because you just use a model and keep putting in numbers to that model and making offers, and you're not close and you don't have the ability to get close. So what I want you to do is be able to get close and understand that, hey, it's no longer amateur hour. You're actually going to have to put in the work, understand your taxes, understand your insurance, understand your debt, right? So you can go out and close that gap and actually be competitive enough to win deals. So if you will change that, right, then you can make a difference. And so knowing that law of cause and effect, when things aren't going right for me and I say this is my effect, then you also can reverse engineer and say what's the causes or what am I doing. So for those of you, maybe you have a coaching program or you've bought a model from somebody else, ask that person if they'll share with you the model of the last deal that they did. Ask someone who's bought a deal recently the process, the thorough process that they did of actually getting that deal to the closing table or actually closing on it or being close enough in an offer to make it happen. What you will find is it's not so much the simple process of just putting information into a spreadsheet and then going immediately to the offer. So I'm done. We're at 40 something minutes now. Was that a rant? I don't know if it was a rant or not, but anyways, it's my opinion of what's happening right now. Let me hop over. Hey, Irish, let me know if anything is coming off of Facebook right now, because it's tough for me to see. I don't have my dual monitors, but for anybody who's on the Zoom, do we have any questions coming in from that? Thank you, Brandon. Yes, secured overnight financing rate, right? That's the software rate that's used. Jim, he's in there telling me about software rate. Okay, so Hammond, thank you for the question. What are good markets to invest into right now doing multi-unit investments? I'm an investor waiting until first quarter of next year. My philosophy on investing is basically I use three sort of criteria, right? One, invest where you are. Okay. As I just mentioned, it's very difficult to win deals. But if you live in a market where there are deals, you've got a competitive advantage over everyone else just because you live there. You know it better. You know what's happening on that street. You know that there's new construction, all that, right? So buy in markets where you live. If you can't do that, next best thing, buy in markets where you have lived or where you used to be, right? So you may say, hey, I used to live in this market. I know it. I have boots on the ground. I got family members wherever, and you can look to buy there. Also, if none of those work, well, you can simply select the market while where you want to be. All right, where would I like to invest at? Where do I think I may have some competitive advantages? I know a lot of people, a lot of gurus will tell you, hey, you need to go look at population growth, and you need to look at job growth, and you need to look at income growth, average household growth. Yes, you should look at all those things, but just understand that if you follow what all those metrics are telling you to do, let's say it's Dallas, Texas, or it's Orlando, Florida. If you do that, right, every other investor who's looking at the same metrics is going to go to the same market, and you've just inserted yourself into a bunch of a competition. So I like knowing those things for the market, but I also like having some other reason behind it. Now, if you're in a place where it's just declining population and no jobs, well, then obviously don't don't invest there. But where you live at, where you're from, or where you like to be, I think are good ways for you to start off with selecting a market. Uh, okay, anything else? Uh, all right, I think if nothing else, we will go ahead and wrap it up. So uh, right at 45 minutes here, I hope that you have found this valuable to you. If you will take it and sort of sharpen your pencil a little bit and underwrite deals, this is a great time to be buying. Why? Because you've got the advantage of evaluating properties based off of income. All right. Just doing that alone, you can hold for cash flow. Back to the basics of real estate, right? You just buy for cash flow, and then you can time the market. Well, not, I won't say necessarily time the market, but if you have cash flow, you don't care what happens in the market. If it's a good time to sell or if cap rates go higher or lower, you got cash flow. But when they bounce back, like historically they've done, you own properties and you would see your portfolio explode by millions. Okay. Johnson says, appreciate the information. You're welcome. Thank you, Jason. I agree. Buy for cash flow. And Paul, yes. If anyone is interested in knowing more, right? If you're looking to get started in apartment investing, then reach out to me. If you're in the Facebook Live, you've got my Facebook Messenger there. For those who attended on Zoom, all the contacts, they will be shared with you all. You can use those contacts, get in contact with me if there's any other way that I might be able to assist you. Jim says, I invest where I can drive or fly in 4 hours. So yes, definitely. Like don't overcomplicate the market, and buy properties across the country just because some metric told you to go there. Thanks for the ad on LinkedIn. Thank you all for being here. I appreciate it. Again, this is happening every Tuesday. I'm hopping in with a subject, looking to answer your questions, looking to provide value to you. So I'll be here next Tuesday at 11 a.m. And I hope to see you all there. Thank you for your time. I'll talk to you later on. Make it a great day on purpose because you deserve it. Later.